Hi, everyone. Thanks for joining us for the week ahead. My name is Tony Nash. We're joined today with Tracy Schuchart, Nick Glinsman, and Albert Marco to talk about the markets for this past week and what's going to happen this next week. Guys, we saw a really dramatic market this week. A lot happening around the Fed announcements, around inflation in Europe. We saw some real action around bonds. So can we talk about some of those things as well as what's happening in energy markets? So Tracy, could you actually get us started with what you're seeing in energy markets?
So we had obviously we had a big bounce this week in the energy markets, and a lot of that had to do with we had problems in Libya with some production offline, 500,000 barrels. We also saw some big drop in Ecuador production, and then Nigeria ongoing problems. Then, of course, we had Kazakhstan, which these protests put potentially 1.6 million barrels at risk. So that was another geopolitical risk factor. And then what we were seeing at home is because of weather, because of the cold snap, we had Keystone down for about a day. And that brings Canadian crude to the United States. And then we're also seeing production problems in the back end. So there were a lot of things going on in this market that, propelled it higher.
Okay. And what about the geopolitical problems with Europe and Russia? Is that still tightening? Do we see that still affecting gas prices in Europe?
I think actually we've seen a pullback ever since the U.S. cavalry came with the initial 46 vessels. And then we've also seen countries such as the Netherlands come and say that they're going to provide more nat gas. So that market's going to be volatile. It's definitely going to remain volatile, but we have definitely seen it pull back off the highs.
Oh, good. Okay, very good. Nick and Albert, can you talk to me a little bit about the Fed? What's your view on the Fed remarks, and will they actually raise 3 times in 22?
Well, actually, my view on the Fed remarks is it was nothing new. We
Right.
knew absolutely everything December the 15th. It was statement and then the press conference. It was very clear. People just wanted to ignore it. So it's come home to roost. What was interesting, the Treasury market was already acting first day of trading and had a really good sell-off, and it's just carried on. Now, I actually, I'm wary of this Fed. Have they got the guts to actually take inflation on, or are they worried about the stock market? And there is obviously that correlation between the stock market and the economy. However, at this high level on the stock market, one wonders whether that correlation is a little bit looser, because we have from a data point of view, whether it's reality or not, it's a booming economy. And I actually had a conversation with a very well-known economist on the street. It's his own shop. And he said a couple of people he respects are talking about unemployment going sub 3% by their measure. Well,
but Nick, that's just a denominator function. Like,
I understand.
We all know it's not really less than 3%.
Well, but we all know that inflation isn't 7.2%, which
Right.
is the forecast for next week. Okay. So, I mean, this data has issues, and I'm very much aware of those issues. But the point is, if this carries on going that way, and the seasonal adjustments accentuate the situation, plus you've got Albert mentioned this last year, there is a huge number of people retiring. So there's a supply shortage of the labor side. It's not just supply chains causing inflation, that labor has a supply shortage.
Well, we've been waiting for this for about a decade, right? For the baby boomers to start really retiring.
They wanted a bit more inflation. They wanted a booming economy. They've got it. Now, the Fed has to show whether it's going to, if the Fed goes all in on it to fight inflation, 170 is not the terminal rate on Fed funds. Yeah, I think it's going to have to be between 2.5 or 3.5. Clearly. I'm just concerned about this Fed in that respect. They've shown no willingness.
I just want to add a real quick thing about that, Tony. I agree with what Nick is saying, pretty clear on that. But from my perspective, the story is: are they going to go with inflation, or are they going to have a recession? This is zero rates or rate hikes. This market is realistically built on zero rates.
Yes,
everybody knows this, right? For them to hike, they would need some sort of stimulus program And even then, you need lower job reports, which I think probably are coming. But then we have a fiscal cliff coming in March that we have to address.
Right, but Albert, we would need a stimulus program with hikes just to stay neutral.
Yeah,
right?
yeah, of course, that's absolutely right.
So
yeah,
here's what I don't understand, okay, and maybe you guys can fill me in, but the Fed has a massive balance sheet. Why even mention rates when there's so much they can do with the balance sheet in terms of tapering, being neutral, and then tightening? I just, that on its own is a massive task. It seems to me that interest rates we're kind of premature for that.
I think they're fearful of tantrums. My view on the tantrum side of things is either the Fed does deal with inflation, so you get then risk assets like equities will have a tantrum. If they don't, it's quite possible, and people wouldn't expect this, the bond market will have a tantrum, but it will be an inflation tantrum. So
right.
You're right on QT, quantitative tightening. I mean, they've got so much in the short end. If they just let it roll off, that's $3 trillion in 2 years off the balance sheet. But then that would cause problems in the short end of the market. Or more.
Yeah, but previously they didn't start tightening for 4 years, right? Yeah. QT didn't start until 4 years after 2011 or whatever. So it was a long time, and I wouldn't expect them to start selling off the balance sheet for an extended period of time. It's just a matter of stopping the flow onto the balance sheet.
Big balance sheet. This is the biggest hedge fund leveraged in the world.
Yeah, it is. Yeah. Okay. Speaking of funds, we've seen a little bit of rotation start in the market this week. So, can you talk to us a little bit about that? And Tracy, can you guys both talk a little bit about the rotation that's underway in markets, and how far will it go?
I mean, it's pretty clear that we're rotating out of the U.S. markets and out of tech, going into China, possibly even Indonesia. The U.S. market is nearing, I think, almost 60% of the entire global market, and that's simply absurd and can't go on. Some are talking about disinflation, but the wage inflation continues to rise, and the supply chain stress isn't really getting any better. So, where does the money go, really? In my opinion, it goes to China right now. The European Union is a mess. Can't go there. Indonesia is a likely candidate, but unless the Fed, they can't hike rates. They need massive stimulus. Everything's rotating out of the United States and out of tech for the time being. I don't know how long it's going to last. I mean, I think the tech sales are, maybe a couple weeks. The Fed needs that to pump the markets via NASDAQ. So, I give it a couple weeks max.
Okay, Tracy?
Well, I mean, I'm looking at it and the rotation within just the U.S. market, not the global markets, but we are kind of seeing a rotation from sort of those from the tech sector, right, from growth to sort of more value, real assets, right? So all week we've seen, the NASDAQ pull back, but like oil and banking have remained very strong all week. And so I think that's kind of where just internally where we are seeing the markets, the commodity markets have done really well this week, metals included.
And how long does that last? Is that something that's just a couple of weeks, or is that something that we see happening through Q1?
I mean, I think it really depends on what the Fed decides to do. So if they decide to raise rates, that's going to kill the tech market, right? Mm-hmm. So that's why I am of the opinion it's going to be a one and done, because it's, what do you sacrifice? Do you sacrifice the markets? Right. Yeah. And are you going to do that? Is the Biden administration going to allow that sort of to happen during an election year?
Absolutely. Tracy is absolutely correct. They're not going to let that happen. I mean, right now, the entire perception of the economy is doing well is based on the market performance.
Right.
So for them to raise rates or rotate into, right now they're rotating into reflationary names. I mean, that helps now, but they need the market to act. They need to act and go up solid.
There is a dark shadow. There is a dark shadow with that view, because, as I said, either you get a tantrum in equities, particularly on growth, or you get a tantrum in bonds, which then feeds into a tantrum in equities. Because if they don't deal with inflation, everybody's saying, well, the Jan-Feb base effects are fantastic. They're high. but we're going to benefit from it thereafter. And I've got this, and Tracy, I think will attest to this, and Albert too. There is this point that as things get normalized, crude oil is going to go up because jet fuel will be in huge demand and people are going to be out and moving. In Europe, there's no normalization of energy prices. They're already way above normalization. You're looking at 5 to 6 times the price of energy from last year. So this is all going to feed through the system. It's going to feed through manufacturing services and comes out as core CPI as opposed to full CPI.
Yeah, but
And
I mean, this week, Nick, we've seen, you know, a 4.5 wage gain causing issues in the market. You know, I mean, this market would explode.
My thought on the data today was it was actually the unemployment. You know, they have said the natural rate's 3.6. Well, we're there first quarter. How can you know, if you look at what happened the last time we had unemployment here, we had inflation at, I think it was 4%. Bond 10-year yields were 270.
They're what, 170 now?
I understand that, Nick, but you know, everyone right now is talking about disinflation, thinking that inflation is going to come down because the Fed's going to help push it down. But how do you get rid of wage inflation? There is no way you can sit there and take.
You're not going to get rid of, you know, supply chain issues either, right?
Cost push inflation. This is where it's changed, and I don't think these central bank staffers have accepted this, that everything prior to the pandemic was demand pull.
That's right.
Now we're in cost push. It's a whole different ballgame. They've already said they can't control the price of commodities. Actually, they can because they can control the dollar, right? You know, I mean, that's the point. But the point I'm making is we've crossed the Rubicon from something that, I'm not saying demand pull has gone away, but we've crossed the Rubicon from something that would be affected by monetary policy and monetary and financial tightening to something that is not going to be affected. This is 1970s redux.
Yep.
You know, where wages were off the chart. Okay,
before we go on, there are 2 questions. First, Nick, you said either there's an equity side tantrum or there's a bond side tantrum. Which is worse?
Oh, the bond side tantrum.
Okay.
Because that will ultimately feed through to the equity markets.
Right. Okay, so the bond side tantrum is worse.
We'll also tell everybody the Fed's behind the curve and not in control. Right.
And I think that's well understood. The other question I have is, Tracy mentioned one and done. Do we all think the Fed is kind of going to do a one and done? I mean, that's my view. It sounds like it's Tracy's view. Albert, is that what you think?
I think so. I absolutely think so. They can't let this thing melt down. They'll bring it down to like 4,400, but you know, that's it.
Okay, Nick, do you think it's one and done?
I'm putting my old hat on as a bond market person.
Yeah.
If they do that, the bond market's going to, because they'll then have to do QE because the bond market won't sit there.
They will do QE. They will absolutely do QE.
I can see
that. They've lined up.
I can tell you
right now. They have it lined up, and they control the bond market as it is anyway, so they can do whatever they want right now. There's nobody else in the world that can hold us accountable for what they do.
So are you saying QE in Q2? Do you expect QE in Q2?
Absolutely.
Okay, that's very interesting. All right, I like that. I think that as a thesis is very, very interesting.
By the way, the rest of the world may need it.
Absolutely, I think they will.
Right?
Of course they do.
I've got a great piece of trade union wage claim in Europe. This is hysterical. So the ECB says inflation's going to trend back to the forecast, 2%. It's all transitory. Lagarde still on holiday, but she'll live or die by that. Every person at the ECB, bar the governors, is a member of the ECB trade union. Do you know what their claim is right now for this year?
They need wage hikes.
5%.
Yep.
I think that's a tell.
It's a tell.
Right. You know, so I think other countries may need the Fed's help. That's where I veer back towards Albert in that respect.
I don't doubt that at all.
My traditionalist central bank nature.
Yeah, I don't doubt that at all. Okay, guys, let's start looking ahead to kind of next week. We've got wholesale inventories, NFIB small business, CPI. We've got retail sales coming on. What do you expect to happen next week? Do we expect, say, retail sales to kind of be moderate, or do we expect the CPI to moderate, or do we think things will continue as they have been?
I'm an inflationista, so I think CPI will be problematic, and we've seen this inflation data the estimates have been lower than the actual. So I'm sort of expecting that to occur. Retail sales, I've not really got a view, to be honest.
I think retail sales are going to come in a little bit higher than most people think. I think the luxury market right now is just absolutely on fire. With a lot of free money has just been floating around the system, and people have been buying things left and right. I mean, even the credit card data show that consumers have just used more credit. So it's pretty clear.
Right.
Okay, so we're 2% 10-year yield is a possibility next week then.
Yep. So also the small business survey, the small businesses that I know, from auto manufacturers to other things, they're having a really hard time. So do you think NFIB is going to, continue to be positive, or do you think it's going to trend down?
Oh, I think we're going to go down. I think the entire reason that they've been talking about a new business stimulus program in DC is based on that.
Exactly, 100%. I think we're definitely going to go see that slowing down and slowing economy.
So they need it, Tony. They need it because they need stimulus anyways in March. So might as well start throwing money around everywhere.
Right. So Build Back Better, is that dead, or are they going to try to take another run at it this month?
They'll take another run at it, but it'll be toned down and probably separated into different pieces.
Okay. Do you think it'll ultimately pass and be $1.5 trillion or something like that?
I think it'll be a part of a stimulus hybrid program of Build Back Better with the business stimulus program in mind. So it'll probably be around $2.5 trillion.
$2.5 trillion. Okay. Anybody else have a view on that?
With the emphasis on the stimulus as opposed to the Build Back Better.
I think you're right, Nick.
I think that, I personally don't think Build Back Better is going to pass anytime soon.
Quick question for Albert. Filibuster won't be broken, will it?
No, they'd be absolutely insane for them to try to do that. They know that they're not going to. They know the GOP is going to have the House and the Senate. For them to sit there and break the filibuster, it would just lead to absolute chaos for a lot of different policies.
Yeah,
it's bad news. That's really bad news.
Oh.
No, tell us more. Like,
no, I mean, if they get rid of the filibuster and to pass that voting law, the next thing that's going to happen is the GOP is going to use the same method to have voter ID for the entire country, and under the same reason and why they want to get rid of the filibuster. It's a carve out, really. It's not entirely, but just a
which, by the way, voter ID in Europe is, de rigueur. Everybody has it.
Yeah, I know, but this is the United States. I mean, nowhere in the world does it but the United States. So we have to differentiate, what happens in Europe. So
yes, we do. All right. So what are you guys expecting to see next week? Are we expecting to see this rotation intensify? Nick, what are you expecting to see in say bonds? Do you see, further, action in bonds, or are we kind of at 2 for now?
Well, I think 10 years can go from, I always look at the 10-year, and in fact, the long bond for many institutions is 5, but the 10 years gives you enough of the long bond and the inflation outlook. We're at 176, 77 today's close. If the data is strong, we go to 2, and that becomes that becomes very interesting. I mean, we travel a long way this week, right?
Yep.
And if you look at the CFTC data, the market's not short. A lot of blood was spilt fourth quarter last year. People aren't really, they're slowly stepping themselves in. Where I'm really interested, I mean, if that happens, we continue to see growth to that value. There's no doubt in my mind. What I'm interested in is, I think the dollar rebounds on Monday. The dollar seems to have a day's lag to what the interest rate markets do. It always, I mean, Albert and I have been speaking about this since we've been together, but I'm interested to see, even with dollar strength, we've seen strength in the commodities market.
Right.
Key metal, and this is one of our theses is this, China is going to be replaced by the Green Revolution. We found a wonderful study in France that was reported in one of the French dailies that was talking about 60% of copper will be used up in about 2-3 years. And then he went through all the other key metals for the Green Revolution. I mean, I think actually copper could go quicker because of the new left winger in Chile.
So you think dollar appreciation and commodities, at least industrial metals appreciation, for the, say, foreseeable future.
Oil, and agriculture. I mean, I think the whole complex, ag's
Right.
crazy. And that's where this time round will be rather like people's disbelief in equities. How can we keep going up, right? This time round, we can have the whole commodity complex elevated.
That's truly scary.
But I absolutely agree, and absolutely will. I mean, my three main themes in the commodities markets for since last year and going into at least 2025 is metals, oil and gas, and agriculture.
Fantastic. Okay,
Yeah,
guys.
I actually think the tech market's going to make a rebound next week, just because the Fed's probably defending the 50-day moving average. I think we see a rebound up until the middle of the week next week.
Wonderful, guys. Thanks so much for this. Look forward to doing it again next week. For everyone watching, please like our Twitter page or our YouTube page. Sorry, so you can get alarms for next week. All right. Thanks, guys, and have a great week ahead.
Thank you.